know, some people think that it's easy to look at what happened in the past in our economy and think that they can tell what happened. But what if, just what if there were a way to predict the future? Lynn Brewer of the Integrity Institute tonight on Public Exposure. I'm Stan Emmerich. Lynn, welcome back.
Thank you, Stan. It's good to be here.
So that's a pretty big intro, but by the way, the Integrity Institute, integrityinstitute.com, it's a very, very interesting website, and there's something very big at the end of the show tonight that we're going to be talking about with regard to the Integrity Institute too. So I would say congratulations, but we'll just save that for the end.
Okay.
All right, the economy. Let's go to the Huffington Post. Just as a matter of fact, today, in today's news, U.S. economy in permanent decline, say 39% of the Americans. This, again, is a poll. But on June the 8th, a CNN poll found that 48% of Americans believe that another Great Depression is likely. Are they right?
Well, it certainly feels like it, doesn't it? I personally think, given the research that we've done over the last 10 years, things are not moving in a positive direction. From a variety of standpoints. We're over-leveraged as a society, and there isn't a lot of profitability coming into the picture.
Now, at the Integrity Institute, just very, very generally, what do you do? And then we'll get more specific a little later.
Right. So we measure and rate the structural integrity of public companies at this point in time and predict or the likelihood or propensity for allegations of securities fraud to occur at some point in the future. We've looked at over 33,000 public companies.
33,000?
Yes, 800,000 quarterly financial statements, and been able to identify a pattern of behavior that exists in companies like Enron and Lehman Brothers. Here's the key. The model is predicting that pattern of behavior or the impact that's likely to have at least 2 years in advance. 2
years in advance. Wow, that's something, because if there is a bad behavior that's happening and you could predict it 2 years in advance, that bad behavior usually leads to bad economic performance too.
Well, certainly CEOs, like the rest of us, don't like to share bad news. And so what the model does is detect whether the risk culture or the culture of the organization has got a risk appetite that's exceeding its ability with its risk oversight.
There are a lot of people inside the government and outside the government who believe that they know what's wrong with the economy. Robert Reich, former very, very high up and a very, very strong economist, according to some people. Others don't like him, but he served in at least one of the Clinton administrations, if not both. Are we ready with that video? Because this is really, really good. Robert Reich, right now.
What's the problem with the economy? Let me connect the dots and show you the big picture in less than 2 minutes, 15 seconds. Dot 1. Since 1980, the American economy has doubled in size. But adjusting for inflation, most people's wages have barely increased. Second dot. Where did all that money go? Almost all the gains have gone to the super rich. The top 1% used to take home about 10% of total income. Now it takes home more than 20%. And the super rich have 40% of the nation's entire wealth. The third dot. All this money at the top has given the super rich lots of political power, especially power to lower their tax rates. Before 1980, the top tax rate was over 70%. Now it's down to 35%. And much of their income is capital gains, subject to only a 15% tax. According to the IRS, the richest 400 Americans pay only 17%. Fourth dot. This means huge budget deficits. Tax revenues are down to less than 15% of the total economy, the lowest in 60 years. So public services are being cut at all levels of government. Our kids are being crowded into classrooms with more and more other children. Roads, bridges, levees, healthcare, safety nets, they're all being sacrificed. The fifth dot. Instead of joining together for better wages and jobs, many people are so scared that they're competing with other working people for the scraps that are left behind. So we get union versus non-union, public employee versus private, native-born versus immigrants. Final dot. The vast middle class, unable to borrow as it could before, no longer has the purchasing power needed to get the economy growing again, which means continued high unemployment and an anemic recovery. So you see the big picture? The only way we can have a strong economy is with a strong middle class.
MoveOn.org. Political action is responsible for the content of this advertisement.
So, Lynn, is he right? Have the gains in our economy gone to the super rich?
I just can't argue that they haven't. When we look at a number of things that are occurring in the marketplace, executive compensation through the roof. At the same time, pension funds are underfunded, so they're tapping our retirement for their future retirement.
I have to ask you, do you have a political agenda here?
No, it's
with a big P, so that you're a D or an R or one of those?
I don't personally have a political agenda. I think it's sort of both sides of the aisle. Given our model looks at self-interest, political parties have self-interest, and at the same time as we find some political parties going after some of the big Wall Street firms, they aren't looking in their backyard as to what the public companies are doing in their own backyard.
So we've got, Reich is correct. There are gains that have gone to the super rich and have become more and more rich. But is he also right that money, with this super rich status, does money comes political power?
It does become political power. Lobbyist groups. It is very, very expensive to run for political office. So in order to retain their position of power, it requires that they raise money. Similar to CEOs, in their ability to retain their position of power means that they have to raise stock price.
Interesting. Just today, as I was doing some research for the show, I happened to notice this article that talked about how Goldman Sachs had spent over $1 million just in the first quarter on lobbying expense. And so I went to their website, and goodness gracious, what I saw there was this great work that they're doing, new opportunities for New Orleans. And of course, you see that, but then in the upper left-hand corner, you see who it is. So I want to instead go from Goldman Sachs website to the Rolling Stone magazine. This was the first of two columns we're going to talk about. The first one is the Feds versus Goldman, and this was from April of 2010, over a year ago. And the subhead was, the government's case against Goldman Sachs barely begins to target the depths of Wall Street's criminal sleaze. Now, you're in the evaluation business, essentially. Criminal sleaze, that's out there, isn't it?
Well, I think that, clearly Goldman Sachs is now the 900-pound gorilla. But we sort of have to look at what happened between 2007 and 2008 when these investment banking firms began to fail virtually overnight. Mm-hmm. And yet Goldman was saved from that fate, both by an infusion of capital from Warren Buffett as well as Hank Paulson, who was
Goldman guy.
The Goldman guy. He was the former chairman of Goldman. Mm-hmm. And so
And now what was his job in the federal government at that time?
So he was the head of Treasury at the time.
So essentially the architect of the bailouts.
That's exactly right.
Okay.
And so he worked with Ben Bernanke to keep us solvent, and in doing so decided to let his competitors or his former competitors fail. At least an emotional conflict of interest.
But now we have a whole new administration, right? Mm-hmm. But now Geithner, who has Paulson's job, he's a Goldman guy too, isn't he?
I'm not really sure where Geithner came from long term, but he was the head of the New York Fed, the Federal Reserve of New York, before that. Certainly he's been in a position of power for quite some time, and certainly been part of the certainly he didn't stop what was coming down the tracks in a freight train, that's for sure.
Well, we saw the first article from the Rolling Stone and about the Feds versus Goldman, and this was in April 2010. But now let's fast forward a year. May of 2011, it's the People versus Goldman Sachs. And the author, the subhead says, a Senate committee has laid out the evidence. Now the Justice Department should bring criminal charges. And here's the quote. Again, May 11, 2011. While much of the Levin report, we're going to talk about that, describes past history, the Goldman section describes an ongoing crime, a powerful, well-connected firm with the ear of the president and the Treasury that appears to have conquered the entire regulatory structure and stands now on the precipice of officially getting away with one of the biggest financial crimes in history. That sounds like today to me.
Well, certainly, again, our research would indicate that culture runs deep, and the risk culture within Goldman Sachs that created the situation that we're currently in or contributed to it, it doesn't go away overnight. You know, it's sort of like...
Well, it sure didn't this past year, because their compensation for their staff was at, while their income went down by 13%, their staff salaries only went down and bonuses only went down by 5%. So it was triple more of their investors actually took more of a hit.
Yeah, since Matt Taibbi came out with that article, they've lost an enormous amount of market share, or not market share, but market capitalization as their share prices dropped. Analysts are now downgrading them. So I think the handwriting is on the wall, and I do not think the president will get reelected, especially if the Republicans take to task Goldman Sachs. Now, herein is the thing, because they want the money that Goldman Sachs is willing to fill into their coffers. But certainly, if you look at President Obama and his political connections and the contributions that have been made, Goldman will pay to keep their name out of the justice system, I think.
But I'm concerned or confused, because I thought that it was Goldman's guy that was the architect of this plan under the Bush administration.
Yes. However, when you get to that level, whether it's Geithner or Bernanke, remember Bernanke's still in that position. And I think when you have a president who comes into his position of power with the terrible hole that we were in, I think you don't want to do anything to upset the apple cart and then have the responsibility on your shoulders. And let's face it, President Obama was not an economist coming into this. And I think his area of expertise he has to rely on people who have been there for quite some time.
Very big in the news just recently has been the income equality. This was out of the Seattle Times. Income equality grows as CEO pay climbs above historic levels.
Or inequality, we should say.
Yeah.
Yeah,
and just get right into it. Again, this was June 25th. Here's the quote: "Little has changed in the financial sector." Let's stay with that. Jamie Dimon of J.P. Morgan Chase, buyer of Washington Mutual, made 627 times more than the median wages of the average worker. Again, 627 times more than the median age of the average worker. That's amazing.
Well, I think it lends itself to a culture where the CEO is out of touch with reality.
But the board approved the pay.
Absolutely, and I'm sure that the board at the same time is looking at the risks that if they lose the historical knowledge that Mr. Dimon has, they will be at risk. We got to take a very short break. We are very fortunate today to have Lynn Brewer with us, who is the founder and CEO of the Integrity Institute. The Integrity Institute is an entity that evaluates public companies. You're going to really want to stay tuned for the show tonight, because what it is that there's a big announcement coming at the end about what's happening at the Integrity Institute. And you can go on the website, the Integrity Institute, or integrityinstitute.com, and you're going to learn an awful lot more. Let's continue on talking about CEO pay, because while Jamie Dimon was 627 times the median age of the average worker at his firm, it's not just him. No.
CEO pay skyrockets compared with workers' wages. Exactly what Robert Reich was talking about.
Absolutely. The top 100 paid CEOs this last year made, on average, $26 million. The top CEO made about $80 million.
Now, I've got to ask this, though. I mean, if they're making money for their company and their employees are happy and the economy's booming, I mean, why not?
Well, one would argue that if they're making money for their shareholders and making money for the company as a result, the question is not whether they're making it this quarter or this year. It's whether they will continue to make that money over a long period of time without having to put the company's future at risk. And that's where I'm just not sure they're connecting the dots.
We're going to be careful as to what types of predictions that we make, so we're going to have to talk a little bit about the past. Let's talk about the integrity index in relation to Enron. So we're going to put a graphic up, and part of this graphic, I unfortunately didn't put part of it up there. So can you please explain what this tells us?
Sure. Of course, I came from Enron, as did the co-founder of the Institute, and we began to look both from our personal experience as we developed this predictive model. And what we found is early on in the 1990s, Enron's integrity index score on a scale of 1 to 1,000 was doing very well, but then it dropped dramatically. And at that time, Enron went and got California Public Employees Retirement System, the pension fund for California employees.
Yeah, CalPERS.
To do a strategic deal with Enron and put in $250 million of their pension money into that. But the model then looked at Enron's performance as to whether or not it was sustainable. And the model predicted in 97, 98, that Enron's performance was not sustainable without ultimately committing securities fraud. And unbeknownst to CalPERS, they put in another $500 million. Of course, the accolades and the stock price was going up, but the index number was dropping dramatically, showing that Enron could not sustain its earnings.
But there's more. Not just about Enron. Let's go to the problem.
Okay.
We're going to go to this next company. What is this telling us? And we're not going to say who this company is.
Right. So this particular company was alleged by the SEC to have committed securities fraud in 2009 for the period 2002 to 2003. Why it took them 7 years to actually find the problem, I have no idea. They paid a $50 million fine to the SEC. They paid $200 million in audit and legal fees. But here's where we are suffering at the hands of these CEOs and the companies, and that is they lost $170 billion with a B of our investment money in that company and our retirement investment in that company.
Because pension funds oftentimes are big purchasers.
Yeah, and this is a Fortune 50 company.
Fortune 50 company. And so you would think that with a company being that big and that substantial, that a pension fund would be safe, but instead it wasn't.
No, it wasn't. Just as the pension funds that invested in Lehman Brothers and WAMU and Bear Stearns
And
Enron lost, I think in Enron it was $114 billion that was lost in Enron.
Wow. Let's go to the prediction then. We're going to go to the next slide because the prediction talks about, according to the Commission's complaint, this particular company met or exceeded the final consensus analyst earnings per share expectations every single quarter from 1995 through its filing of its 2004 annual report. So they're complying with the law?
Well, actually what the SEC is saying there is that this pressure to perform, so analysts make these predictions that the company will do X and based on discussions with the company. And if the company doesn't meet those expectations, they suffer at the hands of analysts who then want to downgrade them. So companies feel enormous pressure. That company ultimately hit its earnings target 64 quarters in a row, which is statistically, I will say impossible, but statisticians will say improbable. But it is, you cannot, Warren Buffett says, look, I don't know what's going to be in my wallet next quarter, let alone next year.
Yeah, wow. So how'd the CEO do?
The CEO actually managed to do quite well.
Yeah, let's go to that slide. There it is. 2010. Good. Well, keep going.
Yeah. So ultimately, this CEO made $21 million, while the average worker made about $33,000.
Wow.
It was 645 times that average of the worker that works at that company.
At the same time where they were basically committing securities fraud. Okay, well this is good. This gives me just a lot of confidence then that my government is protecting me, or not.
Or not.
So we're going to have to do that ourselves. Okay, let's go on with the problem because we've got some time that we're going to talk about a few of the companies who are in the past, like Bear Stearns and American Home Mortgage and Merrill Lynch. Let's actually go to that slide. And tell us just a little bit about these companies.
Okay, so what began with this Dow crash, it triggered in August of 2007, August 4th actually. George Soros has actually said that the point at which the government realized we were in trouble is when American Home Mortgage failed virtually overnight, 2 days later. American Home Mortgage was the largest mortgage lender. Then it was followed shortly thereafter, a couple months, with Merrill Lynch, Lehman Brothers, AIG, and then ultimately our own WAMU.
And as we talk about this, we're not talking about this from pure historical interest. And instead we're talking about it, have we made the changes today to keep this from happening again? And I read article after article after article from people in the business saying, no, we haven't.
No, I don't think so. Culture is an interesting thing within an organization. Every CEO knows they have one. They just don't know how to define it or how to quantitatively measure it, or much worse, the impact it may be having on the company's long-term performance or the structural integrity of the company.
Let's go to some of the individual graphics with regard to the companies themselves. This particular one here is Bear Stearns. Tell us what this says.
Okay, so what we did...
I see all red on there. That's bad, right?
Yeah, red is like fatal heart attack. It's high cholesterol.
Oh, okay.
And so what we did is we looked at these companies again from 1994 to 2010, and we looked at the 4 years leading up to these failures of these companies. And consistently the companies were in the red, and which means that the company's performance is not sustainable. And it looks like in these cases, clearly the handwriting was on the wall. In each and every case, they mirror that of Enron. And so if you sort of look at this pattern of behavior, meaning these numbers that identify the risk culture of the company, any company that sort of follows this pattern would be a warning sign. So now what we can say is that we can't guarantee that there will be allegations of securities fraud. We don't even sort of care about securities fraud. We care about the investors and we care about making sure the CEO knows that the risk appetite within that company has exceeded the risk oversight.
So but if you're a CEO, let's say that you were the CEO of Bear Stearns and you weren't making the outlandish $20 million, you were just making a mere pittance of $10 million a year, and someone in 2004 from your company had come to them and said, hey, here's what we're seeing. You might want to take advantage of this information and maybe make some significant changes. What is likely that a CEO in that circumstance would do?
Well, I think that we're betting on a couple of things. One is that most importantly, institutional investors will take a look at that, because institutional investors look at these from a long perspective, which is they invest in these things for the long term. And so if the CEO is at risk of putting their investment dollars, sort of washing those down the drain, then institutional investors are going to hold CEOs accountable. That's our first thing. And when that happens, the CEO risks losing their job. And that's the fear of the CEO, is that position of power and all that wealth that goes along with it will go out the door.
So if you don't have a board that asks a lot of questions, or if you have essentially an insider type of board, then it's probably a company that you want to ask a whole lot of questions about yourself as to whether or not you're going to invest in it.
Right. So if I know that there is a 99% chance that I'm going to get cancer at some point in time, the CEO and the board have an obligation to make sure that they mitigate whatever chance that might have to happen.
Our time is dwindling, so I want to get to something. The Integrity Index essentially is predicting the future or changing the science of corporate performance analysts, and it may be a leading indicator of stock price fluctuations. And so what I wanted to do then is to go all the way to this article from The Street. And it's U.S. banks are going to shrivel. And this comes from not an analyst, but somebody who makes his money off of this. And he says this, because it's in response to Basel III, we'll talk very briefly about that. The largest U.S. banks, including the Bank of America, Chase, Citigroup, and Wells Fargo, would be able to meet the higher capital standards they would face under Basel III by letting their retained earnings build over the next several years. That says to me, we're not going to be loaning money.
We're not. And if we don't loan money, then you absolutely will have trouble getting this economy back on track.
Today's New York Times, Joe, let me get this to you because here's what it is. So we're not loaning money because of Basel, not necessarily because of Basel III, but because banks have to be more responsible. Is that what it is?
Well, there is some regulatory pressure on them, but I also think that sadly that the CEO needs to continue to be compensated
In a regular basis. Okay, the Bank of America settlement has been viewed as a blueprint for more PACs, and the high cost paid by the Bank of America was raising expectations for what other banks might have to pay to investors claiming the mortgages underlying securities they purchased had been improperly underwritten. Very quickly before we get to the finale, it sounds like there's going to be a lot of banks that might be looking at having to pay a lot of money.
Yeah, those that are going to be left, because ultimately there is FDIC requirements. There are also regulatory requirements, and particularly Basel III, that will require them to have capital reserves. And if they end up paying these out and they have not fully expected or accounted for them, there's going to be some real trouble brewing.
I wish we had more time, but I got to get to this, and it is from your website, the Integrity Institute itself, integrityinstitute.com. Essentially, you talk about numbers. Can you think about the power of numbers? What are you telling us?
Well, it's like anything that if you look at a pattern in the numbers, you can actually identify within the financial statements filed by companies with the SEC. You can actually identify when those companies are mirroring the same pattern of behavior that Enron displayed in its last 3 or 4 years. And our whole objective is to provide sufficient opportunity for CEOs and boards to change that pattern of behavior before it destroys their company and shareholder wealth.
So this isn't government. This is coming essentially private solution for private companies.
Absolutely, because the SEC is not solving the problem.
Wow. Are they ever going to?
I think that they are bureaucratic. I don't understand why it takes them 7 years to discover that there's a problem in a company's financial reports. We shouldn't ever have had to build this model. The SEC should have done it.
And that's going to be the last word. So be sure to go to integrityinstitute.com. December the 2nd of this year, there's a big release. You're going to want to be there. We'll see you again soon on Public Exposure. Take care.